let's look at the other type of potential award that exists out there, right? And that is, or those are, stock options. And we're familiar with options from our discussion about derivatives, right? But here we're giving an option. We're writing the option, right? So we have the obligation. We have the obligation as the company to deliver, right? We are writing a call option. That's what we're doing. The company is writing a call option. That's what the company's doing. What's the employee doing? They are buying, purchasing a call option. What? What are they doing? They're buying a call option. Well, we're not giving them cash. The employee's not giving them cash. What's the employee giving them? The employee is giving them services. Time, whatever it is. This is what I'm giving to get this call option. Not cash, but my service, my time, my intellectual capital, whatever you want to call it. And the company is writing that call option. Don't know whether or not the call option will be worth anything. Neither do they, but they are writing it. So they have the obligation under the option contract, and these individuals have the right. So it's the same kind of option discussion that we had before. We're looking at call, and these are not naked call options because the company actually can issue the stock. They have the stock. So, what do we have to do? Well, if we think about our process, we have to figure out, well, what is the fair value of the option? I can use market approach. Or an income approach. With the restricted stock awards, restricted stock units, we made the assumption that we're using a market approach. We're just looking, what is the stock trading for at the date of the grant? Here, on the grant date, we now have to figure out what's the value of the option. Not the value of the stock, but the value of the option. And we got to see, is the option at the money, in the money, or out of the money? So at the grant date, we've got to figure out what's the fair value. And just like the restricted stock award, restricted stock unit, we're going to allocate the fair value over the service period. Just like that. So with a market approach, if there are actual options that exist out there, we can use that. So we look to look at actual options. The problem is most of these types of options that we're writing for the employees are long dated options, and so there may not be most of the stuff that is trading in the option market for a public company is likely short term in nature. So while we may be able to look at actual option prices in the market, may not be comparable to the type of contract we're writing here for this employee. So what you do, you see a lot of income approach, right? And the income approach for valuing models is Black-Scholes. And I'll put together a video of how to run a Black-Scholes model, as well as how to calculate and what variables we're looking for to put into that Black-Scholes model. And one of those variables is the calculated amount of implied volatility. So you'll see you'll see a video on how do you calculate, first of all, how do you get the data, and then how do you calculate implied volatility. And this is a little bit more interesting because, right, we don't know whether or not the shares are actually going to be issued because they just have the right, to buy the shares at a certain price, right? We're not just giving them the shares. They have the right to buy the shares at a certain price. There's value in the option because if we do a good job, the price should go higher. And so there will be some reason for them to exercise the call option. But one of the things we've got to think about is, well, what's the probability of forfeiture? That is going to influence compensation expense. And that probability of forfeiture could change from year to year, changing how much compensation expense I'm going to recognize. So this looks very similar to the way you handle restricted stock awards or restricted stock options. The real issue is, how do you fair value this thing? How do you go through the fair value process?